The game is freaking rigged against us, you know? I mean, it sounds so like intense, but the reality is you could save and scrimp and delay, and you could put your money away for 30 years, and you can do everything that you've been taught to do thinking it was all right, and it turns out to be wrong.
Let's put more money in your pocket, increase your financial IQ, and create more peace of mind, clarity, and certainty in your life. Welcome to Money Matters, a weekly segment of the Wealth Labs podcast where we tackle the money topics that matter.
And what happens? It's too late. You're now supposedly going to be in retirement. It was supposed to be a dream. It turns out to be a nightmare. Interest rates might not have cooperated. Taxes might rise. Inflation might confiscate your purchasing power. But there is an alternative. There's something else you could do. And as you can tell, I'm really passionate about it because I'm tired of people feeling this pain. I'm tired of people not becoming economically independent, thinking it's 30 years when it's 3 to 7. Thinking that they have to have their money in a taxable account, thinking that they have to just take whatever the stock market gives to them, and if it's risk or loss, then you just wait for the long haul. The long haul sounds terrible. Instead, Del Clark, the human ATM, is going to teach you about cash flow banking. This has been my framework that I unintentionally started to a certain degree at age 19, and it has never failed me. It's been the way that I've capitalized buying a company, putting in a TV studio, paying off high interest rate loans, funding my first New York Times bestseller, and then it's a place that I can go store it again that I've earned around 5% without having to pay tax. So it's outperforming my savings account because it's the same thing the banks do when you put money in theirs. They take a percentage and then they just put it in the same place. Why not cut out the middleman so that you can get those returns and that you can have that safety? So Del, tell us how we do it.
So cash flow banking is just a more elegant, simple system to help you not only capture wealth, but also, create wealth. Mm-hmm. And so,
you get a wealth capture account, which is a savings account.
Right.
Pay yourself first into that. That starts to build up. But instead of leaving that taxable and exposed,
right,
we're just going to have it automatically move to another account.
You have the opportunity to put that in a different account, and the account makes 400% to 800% higher rate of return than you might be getting in a savings account. We use a very specific type of product called a whole life insurance policy. It's a permanent life insurance policy.
Now, 90% of them aren't designed properly. They're not going to work. They're going to be too slow. It's got to be designed properly. Let's talk about that.
Right, and talking about improper design, before I even met you, Garrett, my dad set up a policy on me. I think it was a universal life policy, variable universal life. And after about owning it for a couple of years, he handed it over to me. I got married, I moved to Michigan, and he's like, hey Del, here's this present for you. And being young and naive, I didn't know what to do with this. And so I'm like, well, this is a perfect thing to buy myself a big screen TV. And so I cashed it out, and I bought a big screen TV, and you would not believe how mad my dad was, because he had been saving for years and years in this.
He's like working so hard for you to have this big
what
screen
are you
TV.
doing, right? So that's not the right way to do that. I was being a spender in that moment right there. But yeah, setting up a specific type of life insurance that banks use, that institutions use, called overfunded whole life insurance, allows you to boost your returns by 400%, 800%. It allows you to have asset protection on that money. It allows you to have flexibility so that you can contribute more or less depending on certain situations that you're in.
This is how it's designed to make it
Correct.
work
This
that
is how
way.
it's designed.
And you can access that money
Correct.
before 59 and a half. There's no penalty.
You can.
There's multiple ways to access that money.
Correct. So there's a couple different strategies to access the money. One of which is the flat-out withdrawal. And it's not a strategy that we typically recommend, but if you ever wanted to go and take money out of a policy and never put it back in, you could withdraw the money. The downside to it is it could be a taxable event.
Yeah.
Any money going into it above the basis becomes taxable.
Yeah.
And you can't put the money back in with a withdrawal.
Look, I actually wrote a book on this, and if you're going to want to just click where the arrow is and grab this book for free. Now you'll pay the shipping and handling, but it's minimal, like very minuscule amount. But I'll cover the cost of the book so that if you want to dive into this, we're going to talk about it here. But if you want more information on it, because this is going to be maybe 10 or so minutes on it, that will give you kind of like your own pacing.
Right. So the other way to access the cash in the account is through taking out a policy loan. And when you take out a loan, you're not actually borrowing your own money. You're borrowing money from the insurance company.
And your money's collateral.
And your money is collateralized. Collateralized.
So it doesn't matter your credit score. It just matters how much cash is in the policy.
You don't have to go through a loan application. There's no credit check.
No payback period that's firm that you have to do either.
Correct. Right? Yeah, exactly. So and the money that when you take out a loan, there's no taxes on the loan. There's no penalties. Now there are situations where it could be taxable on the loan. if you step above a guideline called the modified endowment contract, where
So
you're
you just
overfunding.
put so much overfunding beyond what the government really wants you to be.
And people used to do that back in the 80s and 90s, where they
and it
just
didn't matter back then.
Yeah, they could put in $1 million and have it grow all tax deferred and really loaning it out tax free.
And the rules changed a little bit because
That's
it was
right.
a bit abusive.
Right.
So we're talking about, instead of having money in a savings account, cut out the middleman of the bank, put where they put some of their reserves, which is this overfunded, higher cash value life insurance that once it earns interest, it's locked in, has a minimum guaranteed. It has, depending on the state you're in, 100% liability protection or partial liability protection in bankruptcy or lawsuit. And it's available or accessible either because you just take a withdrawal or you get a loan and that you could always pay that back on your own terms, or if you die, the death benefit will tax-free pay it back.
And let's talk about that for a second, because typically when you think of a loan, it's a 4-letter word. But the reality is that when you take out a loan against your life insurance policy, it's an unstructured loan, meaning you have full, control over when you pay it back,
terms.
or you may not even decide to pay it back. In
Like
fact,
you, when you borrow, don't you set up a schedule?
So I usually set up a schedule where, if I borrow out $100,000, I'll just do an amortization over 5 years and pay back a certain amount of dollars every month.
We're all like, just go, I just sold the cabin. Let's go ahead and put some money back in the cash values from borrowing to buy the other cabin.
Right.
I'm more just like, when there's a windfall of money, you're more of a structured way of doing it. Money personality.
Do whatever works for you, though.
Yeah.
But yeah, that's the really nice thing about this, is because there's no structure to the loan. It can be dangerous if you don't repay the loan. If you end up using all the cash value, and then the policy will require another premium, it could collapse on you. And so it's important that you stay above a certain threshold. Typically, you can borrow up to 95% of your cash value in the account. So if there's $100,000, you can have access to about 95. But the other 5% you got to leave in there just to make sure that the policy doesn't.
Well, if interest rates change or the economy or there's a major opportunity.
Right.
See, where opportunity really comes is when people are focused so heavily on their net worth and trying to build it and neglecting cash flow, they eventually, when there's a tough economy, have to cash out that net worth or that asset to cover their cash, and they have to sell it at a discount. Well, you could actually pull your cash value out because it's not going to go down during a downturn and capitalize on that. So I've done that. I bought Remnant Rate, it was full-page ads in New York Times and Wall Street Journal for killing sacred cows at a major discount because because of the timing and through that remnant. So that was an example. Or in 2014, there was an opportunity to buy a business that was in distress that actually increased capabilities of my main business. So like I was able to pull that cash value out, pay it back when I wanted to. I was able to negotiate a better price on this newest cabin that I bought because I could pay the cash out of the policy. So I look at it as if I don't touch it for years, no problem, because it's just the opportunities aren't right, but I'm still getting a good return through my dividends. But if there is an opportunity, it's there. Well, it's just a much better place to store money. Just a better
place. And let me be clear about this. Cash flow banking is not the name of the life insurance policy. It's an overfunded
system.
It's the whole system, and so the system includes finding and fixing your money leaks, understanding your money personality, setting up your proper account structure, having living wealthy and wealth capture accounts. So it's the whole system that allows you to be more elegant and have more control over your finances. The vehicle that we use in this particular strategy is called whole life insurance.
Right, and there's a lot of negative information about whole life, and I think a lot of it's merited because it's either not designed well, it's high commission the way it is, it takes forever to get cash, it's with the wrong companies, or just a lot of people not understanding what's going on because there's something called price, cost, and value. Price is what we pay, it's the price tag. Cost is the economic impact. So something can have a high price and a low cost. Like the right accountant is the best example. They might save you way more tax even though you pay twice as much than another accountant, but it saves you 10 times more in tax. And then value is our overall fulfillment, joy, perspective, that we personally get from it. So when I think about it, yes, whole life is gonna have a higher price tag than term insurance, but we're not looking at something that's just going to be temporary and go away. We're looking at something that's going to be permanent, and it creates a funding structure for cash value.
Correct, right. I mean, you can travel from Utah to New York on a bike, and it's going to be a lot cheaper to buy that bike than buy a nice first-class plane ticket, but it's going to take you a whole heck of a lot more time to get to New York. And so price and value are two different things.
Yeah. So any other sentiments or statements around cash flow banking?
So I would just say that this is a tool that you want to consider as part of your financial plan. This is not the only piece of it. We highly recommend that you are your best investment, that you invest in yourself and your business. But when you make a lot of money, you got to have a place to store that cash. There's got to be
a way to take business wealth and make it personal wealth. It's something that whether you're a business owner or whether you're a college student or whether you're me at 19 years old can start. I started at $50 a month.
Oh my gosh.
First started. Yeah.
Right.
So,
and I think I started at $600 a month. So.
Yeah. Well, thanks for one-upping me.
Yeah, you bet.
All right. Look, the bottom line is we want you to take back control of your personal finances and make it personal again. We want you to have a system to capture wealth and create it with less risk and more certainty so that you can build and live a life that you love.